Alright, this is the first video in a couple that's going to talk you through the everything you need to know about the 2020 Forex trading strategy. So let's get started. Alright, as you can see, I've got my market scope FXCM up, the chart up, and the first thing you need to know is this is an alert-based trading system, which are based on email and text alerts sent by the website timetotrade.eu. They are indicator-based alerts. It's been amazing. So last week alone we earned 781 pips using this strategy. So alright, we'll go through the chart setup. Okay, so I've got, right now we're only working on this one pair. I do not recommend using another pair at this time. It's a euro-dollar, and you can see I've got euro-dollar chart up, and I've got 60-minute candles. Let's go through the chart basics real quick. So as you can see, I've got a couple of things going on. I've got one main indicator on the top line, which is the 200 EMA, and it's easy to add that. You just click that button, type it in. So why do I have the 200? Because in general it's a great overall impression of the trend of the currency in a trending market. So as you can see, the euro dollar's been strong because the dollar's been weak, so the euro's been strong. So you can see the 200 moving average has served as a very solid point of resistance and support. When the price breaks below it, it usually stays below it or goes below it for a short period of time in a long uptrend. And when price breaks back through, that's where you want to pay attention, because it can break through very, very dramatically, as you can see here. We're talking like hundreds of pips, and it's just bouncing off of it, as you can see. There's a few times when it tested it and then broke below, but quickly found a bottom and rebounded again right there. So, and you can see it just continued to test and just keep climbing, and then finally, last Friday, I believe, we had a huge breakdown through the 200 moving average. It started a very long downtrend, and a lot of people were saying the dollar's going to recover. Anyway, so that's the basic overview of the candles. Obviously, blue candles are up in price, and red candles are down in price. So, second, we're going to look at the main indicator. This is what our alerts are based on. It's called stochastics, and it's set at a 20K, 20D, 10 smoothing period. So both the 20 and both the K and the D lines are 20. Just there's a different mathematical formula for each one. Our entry is based on, and our alerts are based on, when this blue line does something in relation to this red line. So as you can see right here, when this blue line crosses down through the red line, we would get an alert that says, hey, the K has gone down through D, indicating to take a short position, or betting that it's going to go down. And as you can see, you'd be absolutely right. There's one thing to notice about the stochastics. I've drawn a 50 line, which is exactly at the 50 mark here, as you can see. And what that indicates is, basically, in order for a short or a long position to do anything, they have to have room to move. So in order to go short here, you'd want to make sure that this cross occurred above 50. If this cross occurred really low down here, it's not going to be a very significant move, because there's not enough room for it to move down. Just like on a long move, you'd want to see how short, how close to the 50 line this up move is. So blue up through K up through D, and that would indicate take a long position, so enter long. But due to how close it is to 50, you would not expect very much action on this. And so as you can see, there's hardly any room to move. There's just maybe like 50 pips or so. Okay, so that's the stochastics. That's the main setup of the stochastics. That's the main purpose, and that is what our alerts are based on. As you can see in this example, you get an email, and we want to know every time the K does something to the D. If it drops below it, or if it crosses above it, we want to get an email, and that's how we trade. All right, the second indicator is the Williams percentage of R. This is our primary exit indicator. Okay, the stochastics is our primary entry into a position indicator, and the percentage of R is primary exit. The Williams percentage of R also serves as a great confirmation tool for an entry, and I'm going to talk about that right now. So let's do this entry again, or let's actually do this one. This is a strong move here. So we got this K down through D, so we're going to go short. So we walk up to our computer at like 2 in the morning, which is when this cross happened. We'll get our alert, wake up, walk in there, and we look for it. First of all, the first thing we look at, and how we would see it, is it would look like this. This is all you'd be able to see. So we would see a K down through D, boom, we knew that happened because we got the email. Second thing you look at, is it above 50? Does it have room to go down? If it's above 50, it does. The higher, the better. This is about 77 is when this break occurred, so great, lots of room to move down past 50. So it looks good on that end. Now let's confirm it by using the percentage of R. The percentage of R has 3 lines, blue being overbought, which means it will go down if it's above this level, 50 being the neutral line, and negative 80 being oversold, which means it's been oversold so much if it's below here that it's got to go up. So let's just use this trade again real quickly. And so we confirm the K down through D, it's above 50, and we're going to confirm that at the time, which this whole candle would not have been completed yet. So we'd probably be looking at the price around here. It's definitely a prime candidate for a short because it's in the oversold condition. I'm sorry, the overbought condition, which is above negative 20, above the blue line. So it's going to go down, and it's going to go down fairly well because it's got a lot of room to move. So we're going to enter that position, and you would just simply right click, create a market order. You would sell it short 100 or whatever you wanted to do. This would be $10 a pip, and you'd hit OK, and you'd get in, and we'll cover stops later. So you'd be in this position, and sure enough, look at all that downward movement. Okay, so not a very big move necessarily. Let's say we got in at we'll call it 42.93. Okay, on our entry. And we follow this down, and the only thing we're looking at to exit once we're in it, we want to confirm 2 things: that the K line eventually does go down through the 50 because that would indicate a strong move, and then that's the last time we would look at the stochastics. Then we'd switch to this, and we'd just be monitoring this. As soon as this gets to negative 80, okay, you're in prime profit taking zone. Basically, you can't go wrong taking profit anywhere down here once this line crosses. What you usually want to look for are a complete crossing and closing of a candle over the 80 line. So once it's gone down, okay, as you can see, it's gone down here, okay, and then you're going to look here, and you want to see that it's also, the trend has also gone down. It's broken down through 50. You're making money right now. The whole time you're making profit, you could be up $100, you could be up $1,000. You don't know when to take profit, so all you do is reference this line. And as this thing starts to round out, okay, you want to really start paying attention. And as you can see, it checked back up, and it closed, and it did cross right there. So we would probably exit the position there. If you didn't, then you would be a little bit fortunate in that you would catch this other drop right here. But just for normal everyday trading, I would personally exit this trade here because it's a slowing of the momentum. And it's coming back up, and it's closing right there. So let's call our exit 41.91, and our entry was, let's say, 43.01. So we'll bring up the calculator real quick, and we'll go 43.01 minus our exit would be, we'll say right there, 41.91, so minus 41.91. And that's 110 pips in that little move right there. And if you multiply that by $10, you would get $1,100 profit. So as you can see, the 2020 system works very well. It is a good setup in that you can confirm 2 things using 2 different indicators. You can confirm the same thing using 2 different indicators. So I think that'll do it for this first video. And when I make the second one, I'll cover a little bit more in detail and do a few more examples. So there you go.